I need you to pay very close attention to what I'm about to show you, because what's happening in the gold market right now hasn't occurred in over 50 years. And I'm not talking about some minor technical pattern or a temporary price spike. I'm talking about a fundamental shift in the global monetary system that most people won't understand until it's too late. Let me start with a question that should make you uncomfortable. What happens when the world's reserve currency loses its privileged status? Because that's exactly what we're witnessing in real time, and gold is screaming the warning signal. On August 15, 1971, President Nixon did something that changed money forever. He closed the gold window. He severed the last link between the US dollar and gold, ending the Bretton Woods system that had governed international finance since World War II. Foreign governments could no longer exchange their dollars for gold at $35 an ounce. The dollar became a pure fiat currency, backed by nothing but faith in the US government. What happened next? Gold went from $35 an ounce to $850 by January 1980. That's a 2,329% increase in less than a decade. People who understood what was happening made generational wealth. People who didn't lost everything to inflation. Now here's what should terrify you. Gold is doing something right now that mirrors 1971, but the implications are far more severe. And I'm going to walk you through exactly what's happening, why it matters, and what you need to do about it. Let's talk about what gold is actually telling us. For the past 18 months, gold has been breaking records while traditional correlations have completely broken down. Normally, when the dollar strengthens, gold falls. When interest rates rise, gold falls. When stock markets rally, gold falls. These are the relationships that have held for decades. But something changed. Gold hit all-time highs above $2,800 an ounce, while the dollar index was strong, while interest rates were at 20-year highs, while stocks were making new records. Every traditional reason gold should have been falling, and instead, it was soaring. This is the kind of price action that tells you something fundamental has shifted in the global financial system. Let me show you what's really driving this. Central banks around the world are buying gold at a pace we haven't seen since 1971. The World Gold Council reported that central banks purchased over 1,000 tons of gold in 2023. That's the second highest annual total on record. But here's the critical detail most people miss. Who's buying and why? China's central bank reported adding to its gold reserves for 18 consecutive months through May 2024. 18 months straight. But here's what they're not telling you. Those are just the official numbers. Industry experts estimate China's actual gold purchases are 3 to 5 times higher than what they report. They're buying through state-owned banks, through Hong Kong, through intermediaries that don't show up in official statistics. Why would China hide the true extent of their gold buying? Because they're preparing for something. They're preparing for a world where the dollar is no longer the undisputed reserve currency. And they don't want to tip their hand until they're ready. The People's Bank of China isn't alone. The Reserve Bank of India bought over 100 tons in the past 2 years. Turkey's central bank has been one of the most aggressive buyers, adding over 200 tons since 2021. Poland, Singapore, Qatar, the UAE, central banks across the world are accumulating gold like their survival depends on it. And here's the pattern that should alarm you. It's not Western central banks buying. The Federal Reserve isn't adding gold. The European Central Bank isn't adding gold. The Bank of England isn't adding gold. It's the rest of the world. The countries that have watched the US weaponize the dollar through sanctions, through SWIFT restrictions, through freezing foreign reserves. Let me tell you what happened that changed everything. In February 2022, when Russia invaded Ukraine, the US and European allies froze over $300 billion of Russian central bank reserves. Think about that for a moment. Russia had accumulated these reserves specifically as a financial cushion, as protection against economic warfare. And with a few keystrokes, that money became inaccessible. Every central bank in the world watched that happen and asked themselves the same question. Could that happen to us? If we have a political disagreement with Washington, could our dollar reserves simply vanish? And the answer, clearly demonstrated, is yes. That's when the gold buying accelerated. Because gold has one property that digital dollars don't. You can't freeze it remotely. If it's in your vault, in your country, it's yours. No one can take it away with a sanctions order. This is what I mean when I say we're seeing something that hasn't happened since 1971. Back then, countries lost faith in the dollar's gold backing and demanded their gold back, forcing Nixon to close the window. Today, countries are losing faith in the dollar's political neutrality and buying gold as insurance against dollar weaponization. But the central bank buying is only part of the story. Let me show you what's happening in the physical gold market, because this is where things get really interesting. The COMEX, the major U.S. futures exchange where gold is traded, has seen its registered gold inventories drop to critically low levels. Registered gold is the gold that's actually available for delivery to futures contract holders. In the past 3 years, registered gold at COMEX has fluctuated wildly, with several periods where it dropped below 400,000 ounces, while open interest remained in the millions of ounces. Do the math on that. If even a small percentage of futures holders demanded physical delivery, there wouldn't be enough gold to fulfill the contracts. The market is leveraged somewhere between 100 to 1 and 500 to 1, depending on how you calculate it. For every ounce of physical gold, there are hundreds of ounces of paper claims. This is the same kind of fractional reserve system that banks use with dollars. And we all know what happens when everyone tries to withdraw their deposits at once. It's called a bank run. And there are increasing signs we might be heading toward a gold bank run. Look at what happened in March 2023. Several large futures holders stood for delivery, meaning they demanded physical gold instead of rolling their contracts forward or settling in cash. The scramble to find physical gold sent premiums spiking. Gold bars that normally trade at tiny premiums over spot price were suddenly commanding $50 to $100 premiums. Delivery times stretched from days to weeks. The COMEX had to fly in gold from London to meet delivery demands. Think about that. The largest gold futures market in the world had to import physical gold to fulfill contracts. That tells you the paper market has become disconnected from physical reality. And it's not just happening in New York. The London Bullion Market Association, the center of global physical gold trading, has seen similar stress. In 2020, during the COVID crisis, the spread between London and New York gold prices blew out to over $70 an ounce. That's not supposed to happen. Gold is gold. The price should be the same everywhere minus small transportation and insurance costs. But when physical gold becomes scarce, when people want the actual metal instead of paper promises, prices diverge. And we're seeing those stresses return. Now let me connect this to something that affects you directly, because this isn't just about central banks and futures markets. This is about your purchasing power, your retirement, your financial security. The dollar has lost over 98% of its purchasing power since 1971. A dollar today buys what 2 cents bought in 1971. That's the cost of a pure fiat currency with no anchor to anything real. And the pace of that decline is accelerating. Look at what's happened just since 2020. The M2 money supply, the measure of dollars in circulation, increased by over 40% in 2 years. The government printed more dollars in 2020 and 2021 than existed in the entire money supply in 2008. That's not an exaggeration. That's Federal Reserve data. Where did all those dollars go? Some went into stimulus checks. Some went into expanded unemployment benefits. But the vast majority went to banks, to corporations, to financial markets. And now, those dollars are sloshing around the economy, driving up prices on everything you buy. The official inflation numbers say inflation peaked at 9.1% in June 2022 and has since fallen to around 3%. But those numbers are manipulated. The way the government calculates inflation has changed repeatedly over the decades, always in ways that make inflation appear lower than it really is. If you calculated inflation the way it was calculated in 1980, current inflation would be over 15%. If you calculated it the way it was calculated in 1990, it would be over 10%. The government has every incentive to understate inflation because Social Security payments, government pensions, and Treasury bond returns are all tied to the official inflation rate. But you don't need government statistics to know what's really happening. You see it every time you buy groceries, every time you fill up your gas tank, every time you pay your insurance premiums or your property taxes. The cost of living is rising far faster than 3% a year. And here's the critical point. Gold knows this. Gold is telling you that the dollar's purchasing power is in serious trouble. When gold breaks out to new all-time highs in dollar terms while simultaneously breaking out in euros, in yen, in pounds, in every major currency, it's not saying gold is becoming more valuable. It's saying all fiat currencies are becoming less valuable. Gold is the constant. Gold is the measuring stick. And right now, gold is measuring a massive devaluation of paper money. Let me tell you about something most people don't understand: the difference between nominal prices and real prices. Gold at $2,800 sounds like a lot. It sounds like gold is expensive. But is it really? In 1980, gold hit $850 an ounce. Adjusted for official inflation, that's about $3,200 in today's dollars. Adjusted for real inflation using 1980 methodology, that's over $5,000 in today's dollars. So even at $2,800, gold is still below its inflation-adjusted 1980 high. But here's what makes this even more significant. In 1980, gold peaked and then crashed because Paul Volcker, the Fed chairman, raised interest rates to 20% to kill inflation. The cost of borrowing became so high that it crushed economic activity, crushed inflation, and made bonds attractive again relative to gold. Can Jerome Powell do that today? Can the Fed raise rates to 20%? Absolutely not. The U.S. government has over $36 trillion in debt. Every percentage point increase in interest rates adds hundreds of billions to annual interest payments. At 20% rates, the interest on the national debt alone would consume the entire federal budget. The government is trapped. They can't raise rates high enough to truly fight inflation without causing a debt crisis. So they're stuck trying to manage inflation with modest rate increases, while the fundamental drivers of inflation, money printing, deficit spending, de-dollarization, continue unabated. This is why gold's breakout is so significant. Gold is telling you that the market understands the Fed's predicament. The market knows that inflation will remain elevated, that the dollar will continue losing purchasing power, and that there's no Paul Volcker coming to save the day. Now, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how Gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties, what the rules are, what the costs are, and whether it makes sense for your situation. Worth checking out if you're concerned about protecting your retirement savings from what's coming. Because here's what I need you to understand. We're not just talking about gold going up. We're talking about a fundamental restructuring of the global monetary system. And that restructuring is going to create winners and losers on a scale we haven't seen since the 1970s. Let me show you what's happening with the BRICS nations: Brazil, Russia, India, China, and South Africa, plus the dozens of other countries that have expressed interest in joining. These countries represent over 40% of global population and over 30% of global GDP. And they're actively working to create alternatives to the dollar-dominated financial system. In August 2023, the BRICS summit in Johannesburg expanded the bloc to include Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. Think about that list. Saudi Arabia and UAE are the world's largest oil exporters. Egypt controls the Suez Canal. Iran has massive oil and gas reserves. Ethiopia is Africa's second most populous country. These aren't random additions. This is strategic. And the common thread is that all of these countries have reasons to want alternatives to the dollar system. Now, the BRICS aren't launching a gold-backed currency tomorrow. That's not how this works. But what they are doing is building the infrastructure for bilateral trade in local currencies, for currency swap agreements that bypass the dollar, for payment systems that don't rely on SWIFT. And gold is playing a central role in this transition. When countries trade with each other outside the dollar system, they need something to settle imbalances. If China sells more to India than India sells to China, how does India pay the difference? They can't use dollars if they're trying to avoid dollars. They can't use yuan because India doesn't want to accumulate Chinese currency. But they can use gold. This is exactly how international trade worked under Bretton Woods. Countries traded in their own currencies, but imbalances were settled in gold. We're watching a return to that system, but without U.S. control. And here's the critical detail. This process is self-reinforcing. The more countries trade outside the dollar system, the less demand there is for dollars. The less demand for dollars, the more the dollar's value falls. The more the dollar's value falls, the more incentive countries have to abandon it. It's a feedback loop, and we're in the early stages. Let me give you a concrete example of how this is playing itself out. In 2023, China and Brazil agreed to settle trade in their own currencies, bypassing the dollar entirely. China is Brazil's largest trading partner, with over $150 billion in annual trade. That's $150 billion that no longer requires dollars. China and Russia have been settling trade in yuan and rubles since 2014, after the first round of sanctions. That's over $200 billion in annual trade outside the dollar system. China and Saudi Arabia have been negotiating yuan-denominated oil sales. If that happens, if the world's largest oil importer and one of the largest oil exporters start trading in yuan instead of dollars, that's the end of the petrodollar system that has supported dollar dominance since the 1970s. Each of these agreements individually might seem small, but add them up. Add in the dozens of other bilateral agreements being negotiated, and you're talking about trillions of dollars in trade that's moving outside the dollar system. And every dollar that's no longer needed for international trade is a dollar that comes back to the United States, increasing the domestic money supply, driving up inflation. This is the hidden cost of de-dollarization that most Americans don't understand yet. For 50 years, the U.S. has exported its inflation to the rest of the world. We printed dollars, and other countries had to hold those dollars to engage in international trade. They absorbed our inflation. But as the dollar loses its reserve status, that inflation comes home, and we're seeing the early stages of that process now. This is what gold is pricing in. This is why gold is breaking out to new highs despite rising interest rates, despite a strong dollar index, despite all the traditional factors that should be holding it down. Gold is looking past the current moment and pricing in the structural changes that are coming. Let me show you what this looks like in the physical market, because this is where theory meets reality. Gold premiums in Asia have been running significantly above Western prices for months. In China, gold bars trade at $20 to $40 premiums over spot price. In India, premiums have spiked to over $60 during high-demand periods. What does that tell you? It tells you that physical gold is flowing from west to east. It tells you that Asian buyers are willing to pay more than Western prices to secure physical metal. And it tells you that the paper price, the price set in London and New York futures markets, is increasingly disconnected from the physical reality of supply and demand. This is exactly what happened in the 1960s leading up to the collapse of Bretton Woods. The official gold price was $35 an ounce, but physical gold in private markets was trading at premiums. The London Gold Pool, a consortium of central banks trying to suppress the gold price, was hemorrhaging gold to private buyers. Eventually, they couldn't sustain it, and the system collapsed. We're watching the same dynamic play out today, just with different players. The paper gold market is trying to maintain prices that don't reflect physical reality, but physics always wins. You can't deliver paper gold. Eventually, the paper price has to converge with the physical price, and when that happens, the repricing will be violent. Now let me talk about something that should concern every American: the U.S. government's own gold holdings. The Treasury claims to hold over 8,100 tons of gold, stored primarily at Fort Knox and West Point. That's the largest official gold reserve in the world. But here's the uncomfortable question. When was the last time that gold was audited? The last comprehensive audit of Fort Knox was in 1953, 70 years ago. There have been partial audits since then, but no complete, independent verification of the gold's existence, purity, and ownership status. Why does that matter? Because there are persistent questions about whether that gold has been leased, swapped, or otherwise encumbered. Central banks routinely lease gold to bullion banks, who sell it into the market to suppress prices. The gold shows up on the central bank's balance sheet, but it's not actually in the vault. It's been sold and is sitting in someone else's vault or jewelry. If the U.S. gold reserve has been similarly leased or swapped, and if there's ever a crisis that requires that gold to be repatriated, we might discover that it's not actually there, or that it's been pledged to multiple parties, or that it's tied up in legal disputes about ownership. I'm not saying this has definitely happened. I'm saying we don't know, and the lack of transparency is concerning, especially when you consider that Germany spent years trying to repatriate its gold from the Federal Reserve Bank of New York, and the process took far longer than it should have for gold that was supposedly sitting in a vault ready to go. This matters because, in a real crisis, in a scenario where the dollar's reserve status is seriously threatened, the U.S. government's gold reserve is the ultimate backstop. It's the asset that could theoretically back a new monetary system or restore confidence in the dollar. But only if it's actually there. Let me paint you a picture of what a real gold crisis would look like, because I think most people don't understand how quickly things could unravel. Imagine a scenario where a major country, let's say China, announces that it's backing its currency with gold. Not a full gold standard, but a partial backing, maybe 20% gold backing. They announce they'll exchange yuan for gold at a fixed rate for international trade settlement. What happens next? Every country that trades with China suddenly has an incentive to accumulate yuan, because yuan can be exchanged for gold. The yuan becomes more attractive than the dollar for international trade. Other countries start following suit, adding gold backing to their currencies to remain competitive. The dollar, with no gold backing, becomes the least attractive currency for international reserves. Countries start dumping dollars, buying gold and other hard assets. The dollar crashes. Import prices in the U.S. skyrocket. Inflation explodes. The Fed is faced with an impossible choice. Raise interest rates to defend the dollar, which would crash the economy and make the national debt unsustainable, or keep rates low and watch the dollar's purchasing power evaporate. In this scenario, gold doesn't just go to $3,000 or $5,000. Gold goes to $10,000, $20,000, maybe higher, because it becomes the foundation of a new monetary system. And people who own physical gold become the new wealthy class, while people holding dollars watch their savings evaporate. Now, I'm not saying this exact scenario will happen, but some version of it is becoming increasingly plausible. The pieces are being put in place, the incentives are aligning, and gold's price action is telling you that smart money is positioning for this possibility. Here's what you need to understand about gold's role in your portfolio. Gold isn't an investment in the traditional sense. Gold doesn't produce cash flow, it doesn't pay dividends, it doesn't grow earnings. Gold is insurance. It's protection against monetary chaos, against currency debasement, against the failure of the financial system. And right now, that insurance is more important than it's been in 50 years. Because the risks to the financial system are greater than they've been in 50 years. Think about the compounding crises we're facing. Unsustainable government debt, persistent inflation, de-dollarization, geopolitical tensions, banking system fragility, commercial real estate collapse, pension underfunding. Any one of these could trigger a financial crisis. Together, they create a powder keg, and gold is the asset that performs when everything else is failing. In 2008, when the financial system was collapsing, gold held its value while stocks crashed. In the 1970s, when inflation was raging, gold multiplied in value while bonds and cash lost purchasing power. In every major crisis, gold has been the safe haven. But here's the critical timing issue. Gold's biggest moves happen fast. In 1979, gold was at $250. By January 1980, it was at $850. That's a 240% move in 1 year. If you waited to buy gold until it was obvious to everyone that you needed it, you missed most of the move. The same thing happened in the 2000s. Gold bottomed at $250 in 2001. By 2011, it was at $1,900. But most of that move happened in the final 2 years, from 2009 to 2011. If you waited until gold's bull market was obvious, you paid $1,500 or more for gold that could have been bought for $300. This is why gold's current breakout is so significant. We're potentially in the early stages of a move that could dwarf anything we've seen before. Because the monetary distortions are greater, the debt levels are higher, the geopolitical tensions are more severe, and the alternatives to the dollar system are more developed than they've ever been. Let me give you some specific levels to watch, because this is where technical analysis meets fundamental reality. Gold's breakout above $2,100 in late 2023 was the key technical signal. That was the level that had capped gold for 3 years. Breaking above it confirmed that a new bull market was underway. The next major resistance level is around $3,000. If gold breaks cleanly above $3,000 and holds it, that opens the door to $5,000. And if we get to $5,000, there's no technical resistance until the inflation-adjusted 1980 high around $5,500 to $6,000. But here's what you need to understand. These technical levels are just guideposts. In a real monetary crisis, technical analysis goes out the window. Gold could gap up $500 in a single day if there's a major currency crisis or a geopolitical shock. This is why you don't wait for the perfect entry point. You don't try to time the bottom. You accumulate physical gold as insurance, and you hold it regardless of short-term price fluctuations. And I want to emphasize physical gold. Not gold ETFs, not gold mining stocks, not gold futures. Physical gold that you own, that's in your possession or in a secure vault that you control. Why? Because in a real crisis, paper claims on gold might not be honored. We've already seen this happen. In 1933, Roosevelt confiscated gold and made private gold ownership illegal. Gold certificates, paper claims on gold, became worthless. Only people who held physical gold outside the banking system maintained their wealth.
Could that happen again?
I don't know. But I know that physical gold can't be confiscated remotely, can't be frozen by sanctions, can't be devalued by money printing. It's the ultimate form of financial independence. Now let me address the common objections people have to gold, because I know what you're thinking. Gold doesn't pay interest. Gold just sits there. I can't spend gold at the grocery store. All true. But you're missing the point. Gold isn't supposed to make you rich. Gold is supposed to keep you from becoming poor. Gold is supposed to preserve your purchasing power when everything else is losing value. Think of it this way. If you had put $10,000 in a savings account in 2000, with interest, you'd have maybe $15,000 today. But that $15,000 buys less than the original $10,000 bought in 2000 because of inflation. You lost purchasing power. If you had put that $10,000 into gold in 2000, when gold was $280 an ounce, you'd have about 35 ounces. At today's price of $2,800, that's $98,000. You didn't just preserve purchasing power, you multiplied it by 10. That's the power of gold during periods of monetary instability. And we're entering the most unstable monetary period since 1971. Here's what I want you to take away from this. Gold's breakout isn't just another bull market. It's a warning signal. It's telling you that the global monetary system is under stress, that the dollar's dominance is being challenged, that central banks are preparing for a different world. You can ignore that signal. You can assume that the system that's been in place for 50 years will continue indefinitely. You can keep all your wealth in dollars and dollar-denominated assets and hope for the best. Or you can take the same action that central banks are taking. You can allocate a portion of your wealth to physical gold. Not as a speculation, not as a trade, but as insurance against the monetary chaos that's coming. How much? That depends on your situation, your risk tolerance, your other assets. But most financial advisors who understand monetary history recommend 10% to 20% of your portfolio in physical gold. Some recommend more. The key is to act before the crisis is obvious to everyone. Because once it's obvious, gold will be $5,000 or $10,000 an ounce, and the opportunity to protect your wealth at reasonable prices will be gone. This is your 1971 moment. This is your chance to position yourself on the right side of a monetary transition that happens once in a lifetime. The central banks know it. The smart money knows it. Gold's price action is screaming it. The only question is, will you act on it? Or will you look back in 5 years and wish you had?